The long-term view of our guest, Marc Faber, has not changed, which is that we are screwed. Doomed, I think is the word
Yes.
you use. Short-term, however, a few weeks ago, Marc was actually relatively positive about stocks for this year, but he recently sat in on a Barron's roundtable in which everyone, it seemed, had gotten very optimistic and very complacent. So you've actually revised your view of the stock market
Well, it
this year.
disturbs me a little bit that at a panel discussion like this Barron's roundtable, everybody was looking for further gains in stocks until maybe March, June of this year, then a correction, and then closing the year at about the same level or up 10 to 20%. So I think that maybe the consensus is wrong and that we could have sooner than that a correction. We have a lot of complacency. We also have to consider we are in a year ending in zero. These years are not particularly good for stocks. And number two, midterm elections are not particularly good for stocks. So I think maybe as a precaution, I would take some money off the table. I also observed in the market that some leading stocks like Google's, Research in Motion, Amazon, Apple, and so forth, they're acting a bit heavy, also Goldman Sachs. So maybe the upside here is quite limited, and we have a lot of momentum players. They are long because it's going up. They're not really believing in a sound economic recovery. And these people could pull the trigger relatively quickly.
So if you take money off the table in stocks, where do you put it?
Yeah, good question. I think, cash has no return, but maybe for 3 months to have some cash reserves is not such a bad idea. Having said all this, I also have to point out that although some stocks are acting heavy, other stocks, they have kind of bottom formations, and frequently they break out on the upside with heavy volume. That especially in Asia.
So U.S. stocks, take money off the table. Is it just buy anything in Asia, or do you have to buy specific
No,
stocks?
Again, the Asian markets and emerging markets have done fantastically well, and certainly relative to the U.S. market since 2002, if you look at the chart, the S&P has been going down and down and down against emerging markets, so maybe the S&P is in a better position. But in Asia, I think that longer term we will have still fairly favorable growth. Interestingly, yesterday at this Barron's discussion, India was not mentioned once. India is the second largest country in the world in terms of population, 1 billion people, with a huge potential. I've just been to India now for the last 2 weeks. And two, Japan, the second largest economy in the world, was also not mentioned once. So I think that there are still some pockets of opportunities, but it will not be the kind of returns we had in 2009. 2009 is kind of a lifetime opportunity to make a lot of money. 2010, at very best, I think you'll make 5–10% on your money, unless you take big risks.
Now, what about bonds? We still have this argument between people who think we're going into hyperinflation, in which case
Yes.
you're going to get killed in bonds,
Yes.
and then people who think that we are Japan, in which case there's a little bit more money to be made as we go to zero interest
Yes,
rate.
exactly. I think eventually we'll go into very high inflation rates, and we had a bull market in bonds 1981 to December 18th, 2008, when yields bottomed out on the 10 years at 2.08%. We're now close to 4%. So in other words, yields have gone up a lot. Now, the return on bonds in 2009 was a complete disaster. It was down almost 28%. Usually when you have that kind of very bad return, the following year is better. So I think that bonds could rebound here somewhat, but longer term, you have to look at exit opportunities out of long-term U.S. Treasuries. Because the long-term U.S. Treasuries, they'll go down eventually for 2 reasons. One, because of higher interest rates, and B, because the credit worthiness of the U.S., the credit rating of the U.S. will go down. So you are going to be hit on 2 sides.
Sounds great. And then lastly, the last major asset class, commodities. Where are we there?
Well, I think that gold is still, from a longer-term perspective, attractive. We had a correction, and in my opinion, we had a rebound, but I think we'll probably test the lows of the corrections around 1,050, 1,100 once again. But longer term, I still like some exploration companies and physical gold. And if someone really is interested in commodities, in a commodity where the return could be very high, then I would look at wheat. Wheat is very, very cheap, but it's not suitable for individuals to play it unless they have a commodities account, because the wheat ETFs, like other ETFs, are very expensive because of the rollover cost.
So you can't play wheat by buying boxes of cereal and or
Difficult.
fields and things.
The best probably for an individual is to buy companies that own farmland or plantations, or buy potash companies that produce fertilizers. That would be a way to play it.
And then oil? Where are we there?
Well, I mean, I think that we may come off somewhat, but the marginal cost of finding an additional barrel of oil is now around $70, so the oil price around 80 is probably where it should be. If oil prices go down substantially, there's no more exploration. And the demand for oil, in my opinion, will keep on rising. Now, for the first time ever, emerging economies have a higher oil consumption than the developed world. So that consumption keeps on rising, and to find new oil is very costly, as I mentioned, and it's very difficult to find it, and it's usually in politically exposed countries. And so my sense is that eventually in the next 10 years you'll have actually much higher commodity prices, not just oil, also grains and other industrial commodities.
Thanks, Marc.
My pleasure.